Hi guys, welcome to Finsights. Today we are going to talk about a new term, stock market index. Rather, we will be talking about the stock market indices in our country, which is Sensex and Nifty. You must have heard these terms. In India, these are the two major indices based on which we judge our economic direction, where our economy is heading. So what are Sensex and Nifty? Sensex and Nifty, they are the indices of a stock market. There are many other stock market indices other than these indices. A stock market is a place where you can buy or sell shares or stocks of companies. An index is basically an indicator which gives us a general idea about the stocks going up or down. The Sensex is an indicator of all the major companies listed on BSE, that is Bombay Stock Exchange, which is located at Mumbai. The Nifty, on the other hand, is an indicator of all the major companies listed on NSE, that is National Stock Exchange. The Sensex goes up when the prices of the stocks of major companies on BSE goes up, and it goes down when the latter goes down. The same condition applies to Nifty. These two are the major stock exchanges in the country. Most of the stock trading in the country is done through BSE and NSE. Now coming to how the Sensex and Nifty are calculated. The Sensex is calculated taking into consideration stock prices of 30 different companies listed on BSE. In the same manner, the Nifty is calculated taking into consideration stock prices of 50 different companies listed on NSE. They both are calculated using the free float market capitalization method. Remember, this is one of the best methods for calculating the stock market index. The 30 companies in Sensex or the 50 companies in the Nifty are taken into consideration and are changed from time to time. And this is done to make the Sensex or Nifty an accurate index. These companies are the largest companies based on the market capitalization method. Okay, so let's try to find out what market capitalization is. Market capitalization is the worth of the company in terms of its shares. To get the market capitalization, or what we call market cap of a company, we simply multiply the current price of a share with total number of shares issued by the company. Now we can understand what the free float market cap method is. Guys, many types of investors hold shares in the company, but only the open market shares of the company are available for trading in stock market. The company provides a list of all its shareholders to Bombay Stock Exchange and National Stock Exchange. These two exchanges have certain set of measures through which they decide how many shares of the company falls under open market shares. So the free float market cap is the total amount that we have to pay for buying all the open market shares of the company. Once we find the free float market cap, we are very close to finding the Sensex or Nifty. The market cap of each of the 30 or 50 companies comprising the index is first determined by multiplying the price of their stocks with the number of shares issued by that company. The market cap is then multiplied by the free float factor to determine the free float market cap. The value of the free float factor lies between 0.05 to 1. A free float factor, for example, say 0.55 means that only 55% of the market cap of the company will be considered for index calculation. The free float market cap of the index constituents is then divided by a number known as index divisor. This index divisor is the sole link to the original base period value of the index. For the Sensex, for example, the base value period it is 1978-79. This value provides for comparison of the index over a period of time. So let's not go into much technicality as of now. Let's understand why are these indices important and useful for us. Indices are the leading indicators of the overall sector or the economy as a whole. Also, indices are used as a benchmark against which the performances are measured of various equity funds. One can compare the historical returns generated by different investment instruments like commodities, debt, etc. and the equity investments, of course. An index in itself is used as an underlying for the derivatives market, allowing a trader to trade in the index futures and options market. Also allowing investors and money managers good hedging tools and instruments for their investments. So finally, let's understand what is the difference between Sensex and Nifty. 1. Sensex is the stock market index for BSE Limited, while Nifty is the stock market index for National Stock Exchange Limited. Sensex comprises of 30 stocks, while Nifty is comprised of 50 stocks. Sensex was founded in 1986, whereas Nifty was founded in 1995. And in the end, here's a list of all the companies that are listed in Sensex and Nifty. Hope you got some idea about index and its calculation, and also about the usage of the stock market indices. Thank you so much, guys. Keep watching this space for more videos on finance, financial markets and financial planning. Do like, watch, share and comment on the videos. Thank you. Bye-bye.